Mike, first off, thank you so much for doing this. I'm excited to learn about it. I got a lot of curiosity and kind of want to just get in your brain because we were talking about this off air a little bit. Like the more I tried to learn about Section 179 and bonus depreciation and how that worked, I felt like I just started going in rabbit holes and I got more and more confused. So again, thanks for doing this. Today we got Mike Carraway and Cooley, CPA tax expert. He's going to kind of walk us through some of these things. And why I really wanted to do this is what we've seen firsthand in our experiences is we'll work with, businesses of all size, all types. And when we mention this or we bring this up, it's like the lights come on.
Yeah.
They don't know about it or they don't realize how beneficial it can be. And there's a lot of aha moments that happen and they're like, oh man, we could really take advantage of this and take care of our business. And it's super beneficial for them. And there's way more to it than I thought what I've learned shortly. So just excited to hear your piece. So if you'll just kind of roll us out who you are, what you do, your experience, and then we'll kind of dive into taxes.
Okay, great. Well, Ben, you're welcome. I'm glad to do it. And thank you for asking me to give a hand with this. You said a couple of things that really frightened me a bit. One, that you really wanted to get into Section 179 and depreciation issues, and that you wanted to crawl into my brain.
Yep.
Anybody that wants to talk to a CPA about tax issues is getting into fraught territory. We could go down a rabbit trail and not come out for a really long time here. I know we're going to try not to do that and keep it relevant and pretty high level. But yeah, just a little about me, just so we have context as we talk about it. I've been practicing for about 31 years now and have worked with businesses and individuals of all sizes in lots of different sort of lines of business, different industries, and a huge piece of what we do has to do with timing of deductions, and some of the most money that people ever spend at one time is, of course, on their hard assets, on their buildings, on structural components, and other just large depreciable items. And I think folks a lot of times don't really understand mechanically how that works, why it matters, how you can make certain moves at certain times of year and get a really good answer. And if you don't know about those things, you might get a really bad answer. So yeah, I'm excited to talk about it today, but I'm always excited to talk about this stuff. So, and don't let me go nuts. We're going to try to stay away from, code section references, a lot of really technical stuff, but I think I'm on the same page with you that what we want to do is talk about this in terms that are going to be relevant to people who are owning and running businesses, right?
So I think it's safe to say every individual and their business is a different scenario. So things we generalize may not apply to you.
Yes, and I'm glad you said that,
Yeah.
So that we'll stay away from giving the technical legal disclaimer. But yes, everybody's situation is fact dependent.
Yeah.
Everyone is unique. A tax situation is like a set of fingerprints. Everybody's is different, and unlike fingerprints, those do change over time. So your particular situation at a point in time is going to differ from anybody else's. The stuff we're going to talk about certainly has general applicability, but the actual final answer depends on a lot of facts, a whole universe of moving parts, and folks need to be talking to their advisor about their particular situation. But hopefully, we're going to give them some stuff to put in their own toolkit to go to their advisor, whoever that is, and say, hey, could this apply to me? Or when they're talking to you guys, say, hey, I want to do this. Let's talk about how it may benefit me in terms of making a move now and whatever it is that Environment Masters may be recommending to them.
Cool. So to not go full Alice in Wonderland, start simple. Let's get the concepts down.
Yeah.
Explain depreciation. What is that? Mm-hmm. And then what's changed recently and in terms of, I guess, the 100%. What does that mean?
Right. Good question. So the income tax rules are built around concepts of certainly magnitude and timing. Timing is a very important concept in terms of income taxation. Of course, everybody knows, well, I've got to file an income tax return every year. And if you run a business that reports separately, I've got to file one of those every year. And methods of accounting matter. Are you on cash basis? Are you on accrual basis? There's a lot of stuff with regard to timing that we could sit here and talk about. But with regard to depreciation, it is a subset of rules that apply specifically to items that can't necessarily be deducted immediately upon purchase. Now, we're going to talk about some ways that they can be, but the default rules for depreciation are you buy certain types of assets and you can't deduct it all at once. You've got to deduct it over a certain period of time, and it depends what type of asset it is. It depends what its use is, what kind of business you're in, and a number of other things, some of which we're going to talk about. So depreciation is just another way to sort of time out a deduction, and you can look at it this way. You can compare it to, okay, you're running a business and you have an electric bill. It's not going to be irrelevant to what we're going to be talking about today. You pay your electric bill every month. When you pay it, you deduct it, okay? That's not the same as when you say buy a building. You buy a building, you don't write off that building day one. You have to depreciate it over a certain period of time. So depreciation is just a set of rules that say how quickly you can recoup the cost as a deduction. Of course, it's not dollar for dollar. You can recoup as a deduction the cost of a thing that you've bought, whether it's a building, whether it is a laptop computer, whether it is a central AC system.
So what's changed as of recent? Because it's like Section 179 has been evolving for like 20 years.
Right.
And that's kind of where we came into this topic, and it was kind of like, oh, wow, you get these massive tax bills, and of course I'm not a tax guy. So I'm learning, but we've had some pretty major changes as of recent that's kind of what we're talking about. Like what's happened and why is this now so beneficial?
Right. It's a good question. And there is a sort of long, and from the standpoint of somebody who does what I do for a living, I'd say dramatic, that'd be laughable to most normal folks, history with regard to Section 179, bonus depreciation, just Section 168, said I wasn't going to use code section references, but that's the main depreciation section. There's a history to this, and it has evolved over time. And certainly you could go back to the beginnings of the Internal Revenue Code and look at the evolution of the history. But over the last, I'll call it 20, 25 years, there have been some significant changes. And that sounds like a long time, and it is. But in terms of the life cycle of businesses and the Internal Revenue Code itself, it's all pretty recent. Starting around 2010, the Section 179 rules and some related depreciation rules started changing. And there's a number of income tax acts, we're not going to go into that in detail, that sort of started intermittently either pouring gasoline on Section 179, maybe pouring a little water on it, bringing it back. There have been a number of events, things like Hurricane Katrina, changes in administration. These things have resulted in changes to our income tax rules overall, and specifically to this conversation, depreciation in Section 179, that have generally moved in a favorable pro-business direction. And when I say pro-business, I know we're not going to get political here, but more deduction faster equals pro-business 9 times out of 10. So when you've got depreciation rules that become more liberal in terms of being able to take more and take it faster, that's a good thing. So again, there's nothing political about that. If you want to pay lower income taxes,
please.
And pay them perhaps more slowly, or save more later, accelerate deductions, defer income, that's the name of the game. These improving depreciation rules matter. So what's happened over time is the Section 179 limits have gone up, and the umbrella of assets and asset classes over which 179 can be thrown has broadened. So we could get really technical about that, but there are more things that are included now. There are more things that can be included given certain elections, which we're going to talk about. And you've also got, not quite as applicable to this conversation, but you've also got bonus depreciation, which is actually not the same thing as Section 179, but it can get the same or a similar answer in being able to immediately write off certain things. So Tax Cuts and Jobs Act, which was the first big tax act after Donald Trump became president the first time, that loosened up a lot of things with regard to depreciation, and a lot of that was made permanent and somewhat accelerated with the One Big Beautiful Bill Act just a year or two ago. So now we've got finally some sort of settled rules with regard to depreciation. If you go back 10, 15 years, it's like Swiss cheese trying to figure out, can I bonus? Can I not bonus? Is it turned on? Is it turned off? What's the percentage? What's the Section 179 limit? It's all over the map. We've got a pretty good set guidebook now for how we can depreciate things and take 179. So to your point, given where the numbers are and given the fact that we've got some things that are in place and are permanent, it's a really good time to look at these things.
So the fact that you said it is actually clearer than it's been in the past really says a lot about me. I couldn't be more confused about it. So I'm glad I wasn't digging in back in the day. Yeah. And I didn't even realize that framework has been evolving for that long. That was actually like more recent history. So that was really cool to learn that. So like you talked about, a business, like most of the time, the biggest investment or the value is the fixed asset. And then you talked about recently that umbrella has broadened. Like we now have more that qualifies with that fixed asset, and is really the reason why like this conversation came to be, and kind of learning what that means. Like what are some of those definition changes? And we don't have to go crazy.
Right.
We don't have to be Alice in Wonderland, but like when someone, because we want people to learn from it, like what like qualifies, or what are those things that you can do to that building, to your business, that meet those qualifications that you can take advantage of this?
Right. I'm glad you said building, and I know the direction we're going here. So if we sort of focus on buildings and building components, there have been a number of changes over the years. Not all are necessarily on point to Section 179, but they are related in that they all are directionally in favor of taxpayers. I tell clients that in terms of capital expenditure, spending money on something that, hey, we've got to depreciate it. And that depreciation may be over a period of time. It may be 179, it may be bonus, it may be a combination of those things applied to classes of assets. This is the best set of rules we've had in place, quite possibly ever, in terms of to what can something apply and how quickly can we deduct it. A number of years ago, a set of regulations came out. The shorthand for it is the repair regulations, and it didn't codify because it's regulations, but it gave us rules on when certain things don't have to necessarily be capitalized in terms of repairing things. It solidified and gave us bright line tests for a number of things where maybe in the past we'd have said, well, yeah, you've got to capitalize that and depreciate it over, hey, the life of your building, or maybe 15 years, or probably at least 7 years. And now it's just a repair, we can write it off. There are de minimis rules now such that expenditures are under certain amounts can be written off immediately, no matter what they are. Now, with reference to Section 179, we have the opportunity to make this election is very much on point. It's called a qualified real property election, such that something that might otherwise not be eligible for Section 179 is eligible for Section 179. And we'll talk about, well, I guess, can I go ahead and just talk about what Section 179 actually does?
Dive in. I'm here to learn.
Okay. So
we'll go through some hypotheticals, so you can tell me I don't know if you want.
And I do. I want to ask you for a couple of hypotheticals, but and I'll set it up. So Section 179 basically says you can write off an asset immediately. That's a super oversimplified explanation, but that's what it is. You have to meet certain requirements, and it has to be certain types of things, and there are dollar limitations. You can do it up to, and this is indexed for inflation, but it's around $2.5 million worth of stuff that qualifies in a year. You could go ahead and write off under 179. That gets reduced as the Section 179 qualifying property creeps up over a dollar limit, which is about $4 million, again, indexed for inflation. You also are limited to your taxable income with computed before 179, so you can't create or increase a loss if you've otherwise got a loss. If you are limited because of your taxable income, you don't lose it, it carries over, so you've got a deferral.
So it carries over? Like, I could use it, I can kick it down the road next year?
Exactly.
Okay.
Yeah, next year. And say, well, I'm going to have a loss next year. Okay, well, it'll go to the year after that.
That's pretty sweet.
Yeah. So
is there a timeline on that?
No, that's indefinite.
Cool.
So you keep that, you use it when you start making money again, when you've got a taxable profit. And of course, good time to remember that taxable income and cash flow are not the same thing, and depreciation is one of the things that is sort of a reconciling item or a difference between cash flow and taxable income. So you can say, oh, if I got the best position to be in is to have little or no taxable income, but have a good cash flow. And that can happen depending on how you're spending money, what you're spending money on, and what tax provisions you're taking advantage of, like Section 179. So that's, in a nutshell, kind of how it works. Probably our big question, our black box here is, okay, what's it apply to? Now, it applies to a lot of stuff that I would say a good shorthand way to look at it is stuff that's not bolted down. This table, that computer, a number of the things in the room here. Sure, they're eligible for 179 when you purchase them. I would guess, well, I know, we're going to talk about some other stuff, and this is where I'm going to ask you for a hypothetical. Give me a hypothetical for maybe a major purchase that somebody...
I got a real one.
Okay.
I got so...
What do you got?
Let's hypothetically spare this. This is for the people as well as for me. I got a 20,000 square foot warehouse.
Okay.
It's a blank canvas. Nothing in it. It's currently unconditioned.
Okay.
Has not very much electrical service, and I want to purchase this warehouse as part of my business. I want to put my fab shop in there. A lot of equipment, a lot of heavy equipment needs to become conditioned, and I'm going to need to upgrade the electrical service. So I need to add a 400 amp panel, probably about, let's just do round numbers, let's say 10,000.
Okay.
And add a 400 amp panel, and then I want to put on probably about 25 tons worth of air.
Okay.
Probably 60, let's say for round numbers, let's say $50,000.
Okay.
So I'm $60,000 into this investment, and I want to finance it. So I don't know if that I don't know if that messes up the world for me, but I'm curious if that's a problem. So I've got $60,000 I want to put into this warehouse. I want to finance this.
Yep.
And it is to build out a new fab shop. Like, how can I use the newer framework of 179 to benefit me as a business?
Okay. I got some good news for you and one word of caution in that example.
Okay.
So let's start with the purchase of the warehouse. Just sort of set the table in terms of context. How much it doesn't matter, but how much are we spending to purchase the warehouse?
Let's round number, we'll say 400,000.
Okay. Here's what everybody needs to understand about that $400,000. And whether you pay cash or probably more likely finance it. You can start depreciating that $400,000 warehouse immediately on it being in service, meaning you're using it. Okay, whether you finance it or pay cash for it. Okay, so well, I didn't pay cash. I've got a note with the bank. I put down 10%, 20%, whatever. Okay, fine. We're going to depreciate 400 grand. The next question anybody should ask is, how long do I have to depreciate it? Because what depreciation is, now there's such a thing as accelerated depreciation, and there's a mathematical formula, and it's sort of front-loaded, but for a building, it's what's called straight line, which means you take the same amount every year. Now, it's prorated in the year you start, but for a business use piece of real property like this warehouse, and I hope everybody who's watching this is sitting down, it's 39 years. So it's arguably half a lifetime.
What makes sense though? I
Yeah.
mean, like it's going to last.
That's exactly right. Yeah. So you got $400,000 that you got to write off over, call it 40 years. All right. So that's just context. Now we're talking about putting stuff in it or doing stuff to it.
Yep.
Now, my one word of caution here is the election that I'm going to talk about. The building needs to already be in service before we put the AC unit in it, before we condition it. Okay. Why? Because that's how the rule's written. That's what the rules on the back of the box for the game say. That's just what you got to do.
What's the duration of time?
Just got to be in service.
Okay.
So I would tell you, I kind of like a little breathing room around there. But
we're gonna have a week of working.
I don't want it to be, at 8 a.m. we start using it, and your team is there at 4 o'clock.
Yep. Yeah. I got you.
It needs to already be in service. Now, can it be financed? Already covered that with the purchase of the building. Absolutely. You don't have to put actual money in it. If you've got an honest to goodness third-party note, you owe the money, we're going to depreciate it.
That's awesome.
Here's what happens with, and of course, you're putting equipment in it. We're not talking about equipment. I'm putting equipment in there. I'm going to 179 all that stuff, all the stuff I'm using to do my fabrication, to run my business. Now, the air conditioning, that's the interesting part. Normally, the default rules are that air conditioning system is a structural component of the building. Also has to be depreciated over 39 years. And normally 39-year real estate property, including components, not eligible for 179, except that it is. You just have to make an election. So the election, if you've got, in this case, a central air system, you said you got to put in 10 grand.
10 grand for the service, 50 grand for the air conditioner.
All right.
So I got to upgrade the electrical service.
Yeah, and that counts. That's part of it.
Yeah.
Okay. So we're talking 50, 60 grand, something like that, right? I'm going to tell you that I'm not going to make you take that 60 grand over 39 years. We're going to give you a $60,000 deduction this year if it's placed in service after the building is placed in service, whether you finance it or not. We just make an election on your tax return that says, hey, we're calling this qualified real property. We meet the requirements, and we're going to take 179 on it this year. That gives you a $60,000 deduction this year that otherwise would have been $60,000 worth of deductions split ratably over a 39-year period. It's just timing, and I use air quotes there because timing matters. You tell me you're going to put $1 in my pocket today versus next year, I'll take it today, please.
So is there a scenario, where like I do this year, but can I make the election next year? Or is it like something I have to do?
Right.
Because I think about, some of a job like some of this, it may take you, and one of the things like we see a lot, like, so if you have a specialty piece of air conditioning equipment, and it has a lot of different additives like fresh air, reheat, things like that.
Right.
Like I may decide to move forward on this project, pay for the equipment, do all that, but I might not get that equipment for 6 months.
Right.
So I asked that question from the thought standpoint of like, yes, I own this building. I've decided to make this investment in this building.
Right.
But I won't finish this project in completion until next tax year.
Right.
So could I still make that election at that standpoint? Or would that look different?
Right. So here's how that looks. And it actually, I've got a little bit of bad news there, but it also helps us from the standpoint of what we were talking about earlier, having the building in service. So, look, Ben and the guys told me I'm not going to get this stuff for 6 months, but I've made my deposit. We've ordered it. It's going to be here a while. I'm in the shop. I'm doing work, but maybe I'm somewhat limited in what I'm doing, right? But I'm using my building. Okay. You're not going to get, whether you're depreciating something over 39 years, whether you're writing it off tomorrow because of 179, whether you're taking bonus on it, depreciation starts when an asset, which can include a building, which includes an AC system, it includes specialty electrical equipment, when it is placed in service. Now, placed in service
Okay.
can be ready for use.
Gotcha.
But you've really got to be able to walk to the thermostat and set it to 72 and walk away from it.
Gotcha.
That's when you start. So the bad news there is, yeah, in your scenario, I'm probably not going to be able to get it and make the election to get it until next year, but I'll still get it.
Yeah, you still get it. Okay.
Exactly.
So we're going to start easing into the rabbit hole here,
All right.
because while you're talking is just giving me scenarios. So let's say I don't own this building, triple net lease.
Oh,
I
okay.
lease this building.
Yep.
But it's on me.
Mm-hmm.
My contract essentially saying all things but the roof are on me.
Gotcha.
So triple net lease scenario, I'm going to make these improvements.
Mm-hmm.
Can I still benefit from this?
Yes. Yes. So, and granted, we're talking about a triple net lease situation, and as you well know, leases
I don't
can
know
be.
if I do, but thanks for giving me that credit.
Leases can differ, but if you're the one who's coming out of pocket or whose name is on the note, you're installing the system, and it's on you. You are the one with the economic risk of loss. Yeah, you can go ahead and write it off. Now, depending on the terms of the lease, it may be that the property owner may be the actual owner of the system, and there's some sort of a payback through rent. So there's a situation in which, well, maybe the property owner is the one that gets the depreciation, but I'm going to say, by golly, that means you're getting paid back for the system you're installing. If you're really on the hook, you're spending the money on that stuff, then yeah, we're going to write it off if we meet all the other requirements. We're going to take 179 on it for the tenant. My firm actually just finished an office build out. We did not actually have to install our own new AC system, but everything else we did, using various rules, it's all qualifying for immediate write-off. And of course, it's what we do for a living, so we knew how to make sure make sure we did it right. But we're just the tenant. If we leave tomorrow, all of that, all the work, all the floors, all the electrical, and and the AC system, it's staying there. We're not packing any of that up and taking it with us.
Yeah.
It's us and the furniture and the computers. But by golly, we're depreciating that stuff. That's our stuff. We are the ones who spent the money on it, if that answers your question.
So obviously, I think pretty mechanical, right? So I'm thinking air conditioners, electrical, water heaters, boilers, all that stuff. Like, is there anything in that, and this is me learning, but like, is there anything in that doesn't qualify? Like, what would be a scenario where something like this doesn't make it? Because I'm actually a little surprised to learn that me as a leasee, like, I get to take advantage of that. Honestly, I was expecting you to say no.
Right.
So I'm talking about this warehouse now. It's like, should I lease the warehouse? It's like,
Yeah, no, I'm going to tell you, and if there is a situation that wouldn't apply, it's going to be so rare and esoteric, I can't even figure out how to describe it. But if the taxpayer, and that's how I define people, the taxpayer in this case is the tenant, is the one who is bearing the economic risk of loss, the one who's writing the check, the one whose name is on the note, that person is, for all intents and purposes, the owner of that property. So that's just a question of, does it qualify? And pretty much all the stuff you're talking about would qualify.
That's cool. As a business owner, that's pretty neat.
Yeah. Now, I will tell you, we ask questions. Okay, what exactly is this item? What does it do? But the kind of stuff we're talking about here, and I know I am really oversimplifying. I'm getting into your sandbox now. We're basically talking about climate control systems, right? More or less. We're talking about things that heat, things that cool. Yeah. And I know that is an almost insulting oversimplification of the stuff you guys do.
But like, honestly, that's what we're trying to simplify this, because it's like, we have customers that have learned, like, in engaging with them in real time, they're learning about it and we're learning about it. So we're trying to be better equipped. So simplification is obviously good.
Yeah.
I'm not a tax guy, right? So it's good so we can help communicate. And it's why I wanted to do this. So no offense. So climate control, heater, cool, keep it simple. We want to turn power on. We want to have hot water. We want to have filtered water, like things like that.
That's right.
Okay. Cool. In that hypothetical scenario where I told you I want to drop $60,000 on this building, and I said I wanted to finance it.
Right.
So what you're telling me is, I finance this job. I'm on the hook for $60K.
Yeah.
But in that year, I spend $10K on my loan. Right. I can depreciate $60,000.
That's exactly right. Yeah, you absolutely have a depreciable basis of 60,000 from the jump.
Sounds like a cheat code.
It does. It does sound like a cheat code, but it's not, because the depreciable basis of property is what you have, is the cash you've spent and the note that you owe together, not just the cash you spent. So yes, you can have a scenario in which you spend 10 out of pocket, but you're on the hook for another 50.
You're gonna spend it. Yeah.
I'm going to tell you, you spent 60.
Right.
Right?
Makes
and we're going
sense.
to depreciate 60. So if it's a qualifying asset and all the other things that we're talking about, I'm going to get a $60,000 write-off that year. Yeah, I mean, worst case, if it doesn't qualify, well, that's part of my building, whatever. But I've still got basis of 60 in it on day one.
All right. So we're living in a world of hypotheticals right now.
Okay.
Okay. If, let's say I put this $60,000 into the building, finance it, have it, get it nice, and then I decide, man, I could probably make a lick selling this building. Like, I'm in a good area, whatever.
Yeah.
I-1 zone. It's hot property,
Okay.
and I sell the building.
Yeah.
How does that look? Like,
Okay.
do I have something to worry about there?
Gotcha.
Like in a gain sense or something?
Right. Now, it's a good question. And this is where things can get, well, I think they're always interesting. This is an interesting wrinkle. It depends on length of time, and it also depends on how long your memory is. Now, people have short memories.
Yes, I do.
Taxpayers have very short memories. So
Targeted right now.
Yeah, you may forget, this is a hostile environment now, right? You may forget the fact that you took a $60,000 deduction in year one, because in year three, when you sell the building, I'm going to tell you your gain is $60,000 greater than it would have been otherwise, all things being equal, because it comes out of your basis.
Yeah.
That's all. It's a zero-sum game. Depreciation is just timing. Now, we can have a conversation about what recapture looks like, because you sell a capital asset and Lord willing, you're going to qualify for more favorable capital gains rates, but depreciation recapture comes back at ordinary rates, which is what you used your deduction against originally. But the timing is, well, the fact that your basis is reduced when you take depreciation matters when you sell the building. Again, it's a zero-sum game. So I'm taking a deduction today as opposed to using it against a gain later if I'm going to sell it in a few years. Now, it may still make sense. You may say, well, I still got more of a deduction over a 2-year period than I would have gotten, and it catches up to me when I get to the end. What if it's 10 years? What if it's 15 years? Again, run the numbers. Time value of money and potential character between capital gains and ordinary rates, those things matter. So it is an important wrinkle, but it's where I always remind people, hey, are you telling me that I've got this gains a lot more? I spent this on this stuff. Where's the basis? Remember?
Yeah.
We took Section 179.
Yeah.
We took bonus, and that's, oh, that's right. So
Advisor's important.
yeah, exactly. And again, sometimes we're a wet blanket, but again, I would also tell you, most cases, I'd rather have that deduction and that cash still in my pocket in year one and have a little more gain in year 3, year 4, year 5, whatever. I just need to know it's coming, and that's where talking to an advisor continually helps, because it's our job to help remember those things.
Yeah, I would much rather have your wet blanket than one from the IRS that's probably soaked in gasoline.
That's an excellent and frightening analogy, but yeah.
I think it goes back to make sure you talk to your advisor. Like
That's
how
right.
fundamentally important that is. Now I'm about, this is the part where you might want to run out of the room.
Okay.
Because I'm curious about this from, your brain has gotten me to go here, and I really don't know any.
So this is my fault.
Yeah, no, this is awesome. I'm getting in there. I'm going to get in your brain. All right. So let's say I own 10 homes that I all rent.
Okay.
I am a landlord.
Yep.
Okay. Can I take advantage of this?
Right. And this is where, and I know we've had a couple of conversations off camera, and I've actually thought about this a little bit more and looked into it. And this is where I'm sometimes accused of being a wet blanket. This is where I'm going to be a little bit of a wet blanket. This particular...
I would rather know on the front end
Right.
than get an IRS wet blanket, right?
Right. So now there are a lot of avenues to explore with regard to writing off assets, be it bonus, be it 179, be it accelerated depreciation under a fairly favorable class life, fitting under a de minimis exception. There's a lot. This is why folks need to speak to a qualified advisor
Absolutely.
to explore all of their options. But there is a difference here, and here's it's a pretty stark difference. Residential real property, which is what we're talking about. So residential rental property, the qualified real estate election for 179 doesn't apply there. So a rental house doesn't qualify. Even if you're putting the same system, you probably wouldn't put the same system. If I'm putting the same or a similar system in a rental house as to what I'm doing in that warehouse, which I know doesn't make any sense, but I can use it for the warehouse, not for the rental house. Not saying there's not some stuff we can do in that rental house, but this particular election, this qualified real property election, won't work on a residential rental.
Okay. So if I guess I asked because I was thinking about that as a business.
Yeah.
So like because it's defined as the residential real property.
Yep.
And not a I guess what making it click is like in service, like the way you define that.
Yeah.
So it's like the business comes to operate
Yeah.
in there because I guess you aren't operating in the residential real.
Yeah.
Does that make sense?
It does. It does. Now, if I wanted to split hairs, I could argue, yeah, but if my business is renting that house,
Sure.
if I got somebody who signed the lease and they're moving into the house, I'm operating. Okay, great. You are. It's just that residential rental doesn't have that favorable treatment available to them. Why? Because that's just how they wrote the rules. And we could talk about some technical reasons. We could talk about maybe one lobby is more powerful than another. But this actually, just backing out and looking at it strategically, these rules exist for the purpose of, you're not going to find me saying an awful lot of really nice things about the federal government and in any administration, but these rules exist to incentivize businesses to spend money.
Yeah.
They just aren't applying this particular rule to somebody who's got rental houses.
Makes sense.
But they very much want to incentivize that guy with that warehouse to spend money with you to condition the air in the warehouse.
So I feel like it's making sense to me, like what qualifies and how we do it. So let's say I'm somebody that wants to take advantage of this. Like what would you advise me?
Right.
Is my first step. What should I do?
Mm-hmm.
Should I make this investment? How do I know whether I should take advantage of it?
Right. I'm not often accused of giving super quick, simple answers, obviously, but if I was going to give a quick, simple answer, the very next step or the first step is, do you have an advisor? And an advisor, and this is in no way a commercial for the kind of stuff we do, but an advisor is not the same thing as necessarily the guy or the gal who does your tax return. They're very often going to be the same person, but they're not necessarily. You need to talk to somebody who you know understands these rules and understands how to apply them strategically and tactically. And you need to ask that question. Maybe the question is, hey man, how do I know? And that person starts asking you questions. When did you buy the building? What are you doing in the building? How much does Ben tell you need to spend? When are you going to have it? At the end of the day, it's math.
Yeah.
You give me the numbers, you give me your fact pattern, and I'll tell you, here's how much it could save you given these assumptions. Now, we always tell people, well, don't spend money just to save taxes, but that's of course not what we're talking about. We're talking about somebody who has a need. Look, I got to deal with the air conditioning in my building. I've got to put in a new boiler. I've got to, I don't have any hot water, whatever. It's something that needs to be done. Hey, I just want to do it in the best way. Okay, tell us your facts, tell us your numbers. We'll run the numbers and we'll tell you here's how much it would save you. Now, that doesn't tell you that you should do it, but it will tell you that if Environment Masters is telling me I need to spend 50 grand to do this, and it's going to be great when it's done, but you're telling me I'll also save 10 to 15 grand on it this year if I do it. Well, maybe that's enough to push me over the edge, or tell me, hey, I need to wait a year. It's just, a tax is just another facet of making a major business decision.
What would be a common scenario, not off the wall, but like what would be a common scenario where you would advise someone don't use this?
Good question. While I wouldn't necessarily advise them don't make the investment.
Yeah.
Again, that's going to be their decision, but a situation in which the election would not do them immediate good would be if they're going to operate at a loss. And if they say, well, it's just a bad year and next year will be great. Well, we talked about carrying forward the benefit into the next year. Maybe we still do it. And we just project forward, when are we going to save? When will we see the savings? Maybe a situation where you wouldn't even bother having the conversation. Look, we're running at a perpetual loss for various reasons. Maybe we are generating a lot of depreciation, or God forbid, negative cash flow. That's no way to run a business. But
Been there.
There are situations in which maybe a business is struggling. Maybe there are other reasons to maybe match up depreciation deductions with loan payments. I've seen people.
That's interesting.
I've seen people do that. I don't often advise it. Almost never advise it. But sometimes if you have maybe a group of professionals, lawyers, doctors, that sort of thing, and you've got partners, you've got owners coming in and out. Well, we want to match up the money we're spending on this building, and we want future professionals who come in to help foot the bill on the building. So we also want them to get some of the benefit of the cost of it. So you can see scenarios like that. But I'm usually going to advise people, let's accelerate everything we can accelerate, unless we're in a situation where we are piling up losses such that we don't know what we're going to do with them.
So we talked about passing forward.
Yeah.
Right. I guess I'm trying to, I don't know if you could put numbers to it, but like, what does that look like? So if we're spending $50,000 that qualifies, and we make income of $25,000 a year for the next 5 years. Like, what does that look like? Like, depreciate, how much can I depreciate?
Right.
Does that make sense?
Yeah, it does. So the 25 is before depreciation.
Yeah.
And I get it. We're super simplifying this because there's a lot, we could, maybe we should, put a whiteboard over here and we start scribbling lots of variables.
I guess I should have just asked it. Like, can I take the 50 for the next 2 years and 25?
That's where. That's
okay.
exactly.
That's what I figured. I was trying to frame that out.
It makes a lot more sense when you say it that way. I was gonna spend at least 5 minutes getting to that point. But yeah,
that was my understanding.
Everything else being equal, I'm going to take. Which means that in this example, I'm going to have net taxable income of 0 in each of those 2 years.
Well.
Which again, what you want to do is compare that to the alternative, and the alternative is, I've taken 1/39th of that each year over the next 2 years, which is barely going to make a dent in my tax liability.
Sure.
I don't lose it. It's still there to be taken one day, either over time or I have it in basis to use against my gain when I sell the building. But again, I'd rather have the deduction today if I'm going to be paying taxes otherwise.
So, I just see it like as I'm kind of getting out of the cloud in my mind and learn, like, especially with a lot of the businesses we work with, specialty equipment, and there's usually like really long lead times.
Right.
Like I was talking about, this is a really good way, sit down with an advisor, obviously. Could be Carraway and Cooley. Mike's great. But sit down, get advised.
Yep.
Look forward and start being more preemptive and using this to strategize.
Yes.
That's where I just feel like, man, I didn't know about how this really worked, and it's like lights are going off for my customers. Like, use this. Like, talk to your advisor, figure this out.
Yes,
Because you got big expenses coming up, and you can benefit from this.
You just gave a fantastic commercial for what we do, or really, honestly, make our lives easier, because in so many scenarios, including scenarios like this, but 1,000 others, we will have conversations with our clients, and we're very blessed. We work with a lot of great folks, but people who are running their business aren't spending their days thinking about, what's my tax return going to look like? When am I going to get this deduction?
Yeah.
They're running their businesses, and I'm glad they are, because it gives me a business to run, because this is the stuff we think about. But we are put behind the 8 ball when we sit down with somebody and we find out that 6 months to a year ago they did a thing and maybe didn't do it in the right order, maybe didn't do it at the right time, maybe didn't get the right documentation, and we may be on the cusp of, or a week past, losing an opportunity for something. So the inverse of that is exactly what you just
Keep your
described.
receipts.
Keep your receipts.
Keep your receipts.
But what you just described is the inverse, and it's the perfect world for us. And yeah, you got big lead time on some of this complex stuff. Now we got time. I want the next conversation, everything else being equal, that somebody has after they've said, yep, Ben, we need to do it. And you say, okay, it's going to be 6 months till we get all this done. We got to order stuff. We got to get crews lined up. Okay, great. I want them then to call me and say, hey, this is happening in 6 months, or it's after the first of next year. What do we need to do? I'll say, the first thing we need to do is to have had this conversation. Great, thanks. We're in perfect position. Let's run some projections. Let's talk about how much money you think we're going to make this year. Let's talk about what else you're spending money on. Let's talk about your planning for the business and other capital expenditures. And this is a major factor in it, but we can run some numbers now. And by the time we get to the way we run our business is, yeah, we prepare a lot of tax returns, but that's the end of the line. Where we do our real work is in planning, such that when we get to preparing the tax return, we're just reporting on all the planning we already did. And the scenario you're talking about gives us all the opportunity to sit down and talk about it and decide, yeah, it makes sense to do it, or no, it doesn't make sense to do it. And do it is not necessarily spend the money. They may have already made that decision. It's, how am I going to treat it? It may even impact how they're going to finance it.
Yeah.
Whether they're going to pay for it out of pocket or finance it. And we will run depreciation and financing, just overall cash flow projections for situations like this. And okay, what if we depreciate it all at once? What if we don't? What if it qualifies? What if it doesn't? Having the lead time you're talking about gives us time to play and do what we do for a living.
Play is a good word there. Yeah. Make tax planning fun.
Exactly.
So I'm going to end it on this last question, because this is the one, when you were talking about that. And so we've got this set of rules right now, right?
Oh, man. Yeah.
I know
where you're going with
where
this,
I'm going. So what does that look like in the future? Like, because I mean, a lot of these things are expensive investments, and I can't just, shoot from the hip. I might need to make a plan, or decide ultimately what I want to do. Like, what's my runway on this?
Yeah. I don't know.
Nobody knows.
Nobody knows. That's the answer that nobody likes to give, but we don't know. Now, we do know, and I said this earlier, we've got some things in place now that are permanent. 179 is indexed for inflation. I can tell you the number's going to go up next year, and it's going to go up the year after that, and it's going to go up the year after that.
Okay.
Yeah, that's unless the law changes, right? Now, 179 is not necessarily on anybody's hit list right now. Well, I'm sure it's on somebody's hit list, but right now, we are in a, relatively speaking, from a federal standpoint with our income tax law, it is business friendly. Now, anybody that has to write a check for income tax may say, that doesn't feel very friendly to me. It doesn't feel friendly to me either. But the fact of the matter is, overall, oversimplifying, income taxes are as cheap now for a business owner as they've been in a long time. Nothing lasts forever.
Yeah.
Administrations change. We've got midterm congressional elections coming up in just a few months. All it takes is a significant change in Washington for things to get put on the radar that may not be on the radar right now.
Okay.
And some of these favorable rules could get clawed back. Now, could it go the other way? And we get to a world where everything can be written off willy-nilly and there's no rules. I guess it's possible. That'll never happen. Could the income tax get totally abolished. Sure, it'll never happen. The income tax is embedded in us from a cultural standpoint. Go tell the real estate industry you're going to take away people's mortgage deductions.
Yeah.
There'll be a riot, and rightly so. I mean, we build our personal and business lives around the tax code, right or wrong, and that's good in that there are certain incentives to be gained from it, or it's another way of saying there are ways that you can maybe send a little less of your money to the government, but it's always in motion. The one thing we know is it's going to change again, and I wouldn't be surprised if we've got some clawbacks to some of the benefits we've got now, because some of the things that were made permanent in the One Big Beautiful Bill Act are things that folks on the other side of the aisle were dead set against, and they're going to come after them again, and all it takes is for that gavel to change hands for the conversation to start again.
Yeah, I think about it from my customer standpoint, so it's harder to be strategic because you don't know how long you got.
It is.
Yeah, okay.
But I'll say this, and it'll sound like you slipped me a 20 to say this, and if you'd like to, that'd be fine. It makes decision-making more urgent, everything else being equal. Meaning saying, well, I'll wait and maybe do it in a year or two. Okay, well, that may make sense, but from a tax standpoint, I don't know what the rules are going to be in a couple of years.
Yeah.
So there is incentive to make decisions now. Spend the money now if you need to. Again, I will never advise anybody to spend money just to pay taxes. Spending $1 to save 30 cents makes no sense unless that dollar needs to be spent.
Right. Yeah, that makes total sense. And I told you it was the last question, but you talking made me think of another one.
Okay, great.
All right. So you said limit goes up because of inflation.
Yeah.
So when you say it to me, I've been at the grocery store a lot, so that means the limit's about to be infinity.
Yeah.
So what do limits look like, and are they qualified differently?
So the limit, it's pretty much universal for anything. Once you've got an asset that qualifies for Section 179, it qualifies for Section 179. The limit for 2025, of course, we're sitting here in 2026, but as a good tax professional, I'm always living a year in the past in terms of filing returns. The 2025 limit was, I think, $2.5 million even, because it got reset. It's up for 26 to, don't quote me on this, glad you're not capturing me on camera saying this, maybe another 60 or 90 grand on top of that.
Okay.
And the $4 million that I mentioned, that once all your qualifying property is above that, your deduction starts going down, which is a weird counterintuitive rule. That's going up as well. So this year it's a little over $4 million, and it'll go up 3 or 4% each year. From there, again,
Of course, you just threw in something that totally confused me right there at the end.
Yeah, right.
I'm like, what? How does that work?
So what it means is,
felt like I was getting somewhere.
Yeah, so you can take up to $2.5 million in 179 in a year, assuming you got plenty of taxable income. Okay, that's a limitation. That $2.5 million starts getting reduced if the total amount of qualifying property that you have gets above $4 million.
Okay.
And that 2.5 and 4 million, those are indexed for inflation. They're creeping up.
And when you say that, you mean as a basis above?
Dollar for dollar. So if you spend $4,100,000,
I get it. Yeah, I get it now.
You can take 2.4.
Not very smart. Yeah. You gotta drag me there.
The rule, it's one of many rules that I don't. If I was in charge of writing the Internal Revenue Code, of course I'd keep it complex, so I'd still have a job. But there's a lot of rules that I would change significantly, and that's one of them.
Man, thank you so much for doing this. This was cool, and it's like I said, I tried to dive into this myself before I came here, and I was more confused. But I feel like you clarified a lot of it. So I appreciate you going. I think we got most of my questions answered.
Okay.
It's super kind of you to take the time,
educate
us. Hopefully, some of our customers can learn from it, benefit from it, take advantage. And I would my last piece that I'll leave it on that I think is the most important. It's have a good advisor.
Yep.
Right. And then from my standpoint as a business owner, especially on an asset that's so valuable, have maintenance, have general maintenance. So like you have the ability to make the plan from a preventative standpoint.
That's right.
So it's like we almost are working in tandem. Like we're looking at this from a long-term viewpoint. Like have maintenance so you know the condition, you know what you need.
Right.
Right. And then be advised so when you have these things come up, you have a good strategy.
That's right.
Right. So that's cool. We work together. You didn't know that, but now
yes, we do.
We're same
And
team.
if I can add to that, and this is a plug for you guys, I say talk to your advisor. You need to make sure you're talking to somebody who's licensed, certified, has the experience to know what they're talking about and to give you good advice. Is that not exactly what you tell people?
Exactly.
You don't want me working on my own air conditioner. You don't want me getting somebody in my house who's just just a general fix-it guy who doesn't really know what he's doing. I need certified, licensed, experienced professionals like the Environment Masters guys to take a look at my stuff, right?
Yeah, and it's this whole conversation has basically like, okay, this is a awesome incentive to where I can be protective, preventative. Like if I am on top of my stuff, if I am proactive and not reactive, like I've got this awesome benefit that I can take advantage of as a business owner. And it is cool how it correlates. Like, right, get a good advisor, like have a licensed maintenance technician that knows what they're doing, that can give you good advice. So what a cool thing for any business owner or, anybody that leasing their building. Like it's cool how it umbrellas and takes advantage. So really awesome. I don't think I have it. You think I missed anything?
I do not, actually. This has been a lot of fun for me, too. I appreciate it. I enjoy getting the opportunity to talk about this stuff. And what we like to do is not talk about it in a vacuum, but talk about it in a way, in how it relates to what real people are doing in their businesses. Because at the end of the day, nobody cares about income taxes for income tax's sake. Nobody cares about what the inner workings of the air conditioning system is. They want to know that the IRS isn't coming after them. They're not paying any more tax than they have to. They're saving where they need to save, and that their house and their office are cool or hot as they need to be, right?
Sure. Yeah.
So, I think we're driving at the same goal. Yeah.
So, Mike, before we close out of this, how could people reach you for advice? Like, what's y'all social media?
Okay.
Give that for everybody, because I feel like people will listen to this and be like, I need to have a conversation. There's going to be people that need help, right?
That and which would of course be fantastic. And thank you for asking. Our firm is again, we do tax returns, but we're essentially a consultancy. These are the conversations that we try to lead with. So we can be reached at our website is carrawaycooley.com. That's carrawaycooley.com. My partner Jessica and I lead a pretty small team of professionals that again focus on consultancy. We can be reached on our website. We can be reached by email. We are also active, fairly active for a group of sort of introverted CPAs on Instagram, on Facebook, and on LinkedIn. We even have a YouTube channel that we don't update as much as we should. Hard to get us in front of a camera. Usually takes a guy like you to get us to do it. But we're out there. Our offices are located in Ridgeland, and we are easy to Google.
Cool. Well, we'll definitely link some of that. Not me, but we'll get it linked because I don't know how to do that. But we'll get it linked so people can access you, because I think this will be a really good conversation for a lot of business owners in our community, and I think there's going to be people that are going to want to talk to you from it. So
great.
It was really awesome. I mean, you made this. We talked about how it can't be simple, but like you made me understand on pretty simple terms. So thank you for answering my questions, spending the time. This was great. If you ever need anything from me, call me.
Thank you, Ben. Really appreciate it.